Okay, Pedro. So, you know, I gave you a question to ask Jay Powell last time. You know, if he thought monetary policy was too loose because of what people are paying for concert tickets, and you
That's
failed
right. I
to ask.
forgot about that.
Yeah,
Yeah.
and so anyway, what's top of mind going into the next couple days with CPI followed by the Fed?
Well, one of the things that's top of mind is just how much discord there's. I think this is like one of the periods where we've seen the most internal disagreement within the Fed that we've seen since the start of the rate hikes. I
Okay.
think Jay Powell has been good about building consensus so far. And in part, that was because once the realization set in throughout the Fed system that they were behind the curve, it was easy to get people on board to catch up, and getting people to align behind 50 or 75 wasn't particularly difficult. But now that we're getting to a point where there's actual, I feel like there's true discord within the system as to whether they should keep going or whether they should wait and see. And that depends in part on what your view is on long and variable lags and how much credit tightening we might get. And so, I'm not saying there's going to be a dissent at this particular meeting, but we're getting closer to the point where people are actually actively disagreeing within the system. And that's going to make for some exciting times, I guess. And the
Okay.
CPI, having the CPI
Yeah.
on the day of the meeting just adds to that mix, right?
Yeah.
They kind of in another kind of communications, maybe not a blunder, but it's not particularly clear when you commit to a pause and you say you're data dependent, but you're not waiting for the data to actually speak for itself, and then the data has kind of gone in the other direction. I mean, it's been mixed enough that they could argue for a pause, but it's hard to say jobs wasn't strong and the PCE wasn't strong, and so if CPI does come in strong, it's going to, again, lead to market doubts about what the Fed is likely to do. Although I think the preponderance is for them to pause and then move again in July.
A
But I don't
skip and
think,
hike,
yeah, skip and
which is
hike. But
exactly what Paul at the beginning of his campaign said he did not want to make the mistakes of the 70s and repeat them, where you have
absolutely,
a,
the
you
start
know, you
stop
have a,
monetary
yeah,
policy, exactly.
right, right. So we're on the cusp of something else Jay Paul said that he's, not going to follow through on.
And if you look at the behavior of other major central banks, they've had to do the exact same thing, right? The
Right.
RBA, the Bank of Canada, they've all had to resume hikes after a pause because inflation is sticky. And that's another reason to kind of believe the hawks when they say and think that inflation is not just going to go away in the second half of the year. Is the trend seems to be fairly global, just regardless of the internal dynamics of particular economies. And it's all very labor driven as well. This sort of post-COVID tightness in the labor market that's befuddling everyone. We have labor shortages from Italy to Canada to to the United States.
Do
So
you think our banking problems are over? Everyone's acting like it is.
I definitely don't. I think it's kind of a slow burning problem, and the Fed threw massive amounts of money and liquidity at it, and so
Mhm.
it's kind of like it's hard to say that it wasn't just a palliative and that it's really actually over, because the banks still have those enormous underwater treasury positions. They're just
Yeah.
simply able to not kind of mark them to market at the moment. And so I don't think we're out of the woods on that front. I also don't think that we know what other financial instability issues might rear their heads later in the year. Because if you do believe in the lags, even if you think the lags are fairly short, chances are that you haven't felt the full impact of the hikes, considering we just hiked at the last meeting. And so uh, there's still potential for other blowups in the financial system. And that's actually the main thing that I think could cause the Fed to pivot. When people, when markets price in, I mean,
Yeah.
I know that they've priced out some of those cuts at the end of the year, but when markets price those in, a lot of it is based on the expectation that the Fed is going to flinch at the very first sign of economic weakness, meaning like the first spike you see in unemployment, the Fed's just going to cave
Well,
and start turning
well, the
around. But I think
market,
it's,
yeah,
go ahead.
the market acted that way after the claims last week.
That's right.
Those,
That's right.
yeah,
It's true. And so, but I think that it's actually going to take a financial event for the Fed to be more responsive and to actually consider reversing course. In
Is there any truth that everyone's looking at the commercial banking system, but most of the credit is being supplied by the shadow banking system? That over 50% of credit and loans comes from there, and they're less regulated, I believe.
Yeah, they're less regulated and a lot more opaque. So they're like regulators have a ton less visibility into what is actually happening there. The irony is that we came into this tightening cycle with everyone warning that the major financial risks were outside of the traditional banking system. But then then you get the first major blow up is right under the Fed's nose, like in the sector where they do have great visibility and should have been able to predict and potentially stop it, or at least kind of give more stern warnings. And they were remarkably kind of honest in that post SVB report about admitting to regulatory failures and the kind of general lackadaisical attitude toward regulation. But now, again, there's no reason to think that just because the problem started at the regional banks that they won't spread to other areas, whether it be money market funds or hedge funds. I mean, money market funds have benefited in the short term from this outflow from the commercial banks because they're just offering higher
what
returns.
kind of paper are they buying? Right?
That's the thing.
Risk?
Yeah, exactly. So they expose themselves to some of the similar risks.
And what about Europe? They actually the bonds they own, notes they own, whatever bonds they own, had negative rates. So don't they actually have to service a losing trade?
Yes,
it costs
absolutely.
them money to carry a losing trade that they won't mark to market, but they have to service it.
Absolutely.
So I'm wondering why we're not hearing about stress in the European banking system as much as we're hearing about it here.
That's a good point. It might be, the ECB started hiking later, right? So it could be part of those lagged effects that we were talking about. So
here's the regional bank chart, Pedro, and to me it looks incomplete. I know we've had a recovery here. That normally things come in threes, and we have two. I think there's another break there, and then you know what? The major money center banks don't look that much better. They took it on the chin. S&Ps are making new highs. Nasdaq's blown off, and this to me looks like a bearish consolidation. Sure, it could go to 34, but I don't think we're going to 37, and almost looks like it could break down again. So to me, it feels like we're whistling past the graveyard with a major banking crisis. Might even be similar to what we had in the 30s.
Yeah, I mean, certainly it might not be that different from 2008 in the sense that you see these small problems bubble up, and then everybody says everything's okay. And,
wasn't that way? And like Lehman went bust, but everyone, the markets kept going, and everything was okay for a while.
Well, after Lehman, things kind of fell apart. But I would say, I would think of it as an earlier, like late 2007 episode where there were things like, WashU and Washington Mutual rather, and Countrywide, and names that we've almost forgotten in the trash bin of history. And and now and then they end up, they ended up being kind of the precursors to much larger blowups. And after Bear Stearns, there was a distinct sense that the worst was over, and everybody, positioned that way.
Oh, that's what I meant to say. Bear Stearns.
After Bear, yeah.
So
and then by the time Lehman came around, then it was another 6 months. Because Bear was in March of 2008. By the time Lehman came around, then you had Fannie Freddie kind of blowing up at the same time, and that's when it got really serious, and the job losses started to enter the hundreds of thousands. And again, we talk about this.
Took a long time, a lag.
We talk about this de facto guarantee of uninsured deposits that kind of emerged after SVB just by the actions of the regulators. And it actually, if you look back, the thing that I remember putting a floor on the market in March 2009 was actually when the FDIC came out and guaranteed the bonds of the major financial institutions. And I kept joking that if I could issue, you know, FDIC backed Da Costa bonds, I would be instantly rich, right? Any of us would.
Right. Yeah.
So once you have the backing of the taxpayer, you're pretty much golden. But one would hope that's not what it's going to take. But it's hard to see how we don't get there, given the speed of the rate shock that we've had,
Yeah.
right?
Yeah. And
So
yeah. So so the Fed has a lot to think about. And don't you think the Fed knew what these banks had on their books before he went on his tightening campaign? Didn't it that
they
he knew there'd be problems with them?
they certainly should have. I mean, that we don't know how much, because it's not the kind of thing that they can admit publicly. But maybe they hope for kind of small breakages that would be credit restraining, but nothing kind of as severe as what we might get. But yeah,
Doesn't
it's
the Fed would see if, wanting to launch a CBDC would rather have, you know, five buddies, five buddy banks, the partners he already has, the Fed already has, and they really become the bank because the CBDC doesn't come from the Treasury, it comes from the Fed.
but I'm not
There's,
actually sure that the Fed is
isn't
that
that a
keen on the
takeover?
CBD. I'm not so sure that the Fed is particularly keen on CBDCs. Certainly not as much as some other world global central banks. They're like kind of
Oh,
lagging
okay.
behind on that front. So I'm not
Good.
sure. And I think that's in part because the financial, the large banks are also not particularly keen on it, because
Oh, they
they
would
see it
cut
as
profits, cut through a lot of profits
exactly,
for them.
exactly. And considering how much influence those banks have on the Fed system, both direct and indirect, and through their presence on the regional boards of the Feds, uh, I don't know that they actually want that to happen, and that's why the Fed is not like a leading voice on CBDCs, whereas the ECB and China are a lot further ahead on that front. So,
Okay.
but if
Interesting.
you recall, the day of the last press conference, Chair Powell said something like, he basically he described for the JP Morgan acquisition of First Republic in quite favorable terms, and kind of suggested that they'd put a line under the sand of the worst of the crisis. And then that night, like Pac West just
Yeah.
tanked, and
Yeah.
it
It's
appeared that things were
contained.
not bad. So
And Janet Yellen's been talking a lot lately. She sees that there will be more consolidation in the banking industry, which isn't that really code for failures?
it kind of is at this point, right? It just means
Yeah.
that it means acquisitions. It also means that they have to loosen their own kind of rules. They've been kind of against additional mergers and concentrations of deposits, but that stuff is only getting worse, which again raises the potential for future trouble down the line. One of the big issues the Fed's going to have on the macro front is that even if headline inflation starts to come down, which it looks like it's going to, given what's happening in energy,
Right.
core just looks stuck, right? It looks stuck at 4.5, the upper fours. And that's a real problem for the Fed, because the Fed does look at core inflation as a better predictor of future inflation than headline. And that's going to make a lot of the Fed uncomfortable. Now I would say there's like a minority within the committee that looks at the skip thing as kind of like a way to buy them time for inflation to fall enough for them to really just pause. They don't actually want to hike further, so they say skip, but they really want to pause. But I
Yeah.
think that's a minority. I think the rest actually do think that there's going to be a need for further hikes.
Well, looking at the 10-year, Pedro, if we start closing over 390,
Yeah,
yields are going to new highs.
yeah,
360 has been a big level. If you look to the left, see 360, big pivot. We
yeah,
broke out, went to targets. Here we are at 360. This formation implies a decline in yields, especially
yeah.
if we break down. We could be under 3%. What do you think could cause that? Could it be risk off or another banking problem? What could drive it? Do you think the inflation numbers are enough to take yields from 370 like to 280?
I think yes. I think if there were the impression that the Fed has a lot more work to do, right? Um,
Well,
then
no, these
then
are yields dropping. If we drop
oh,
from
I see what you're saying.
yeah,
Oh, I'm looking.
370 to 280, the only thing I could think of would be some type of
Yes,
risk off
then
event.
yes, a risk off event that does the opposite of what I just said. Rather that like
Okay,
leads people to believe that the Fed is actually going to have to reverse course. Yes,
okay. So
but again, I would think that it would take a financial event for them to
right.
believe that, rather than just regular old economic weakness. Um,
Okay. What are you looking forward to asking them?
well, these days I don't go into the press conference. I send my colleagues in because they tend not to give
Oh,
me the mic. They tend not to give me the microphone, so I prefer not to waste the question. Um,
all right. Okay.
but but and but the questions are kind of pretty obvious. They're like, I think one of the big questions is, what are the long and variable lags? Because that tells you a lot about where they think they are in the cycle. And there's a huge discrepancy within the Fed system as to whether you think that the transmission mechanism has gotten faster because of kind of greater transparency and communication, which means that you've already kind of absorbed the bulk of the hikes and you might need more because they haven't had their effect, or whether the bulk of tightening is still potentially to come, in which case, like, the pause scenario makes more, you can make more of a case for it.
Okay.
Another thing is just kind of narrowing down their reaction function. I think there's a lack of understanding in the markets. That's the reason for it is that the Fed itself isn't very clear about this messaging. Like, what are they actually reacting to? Data dependence is like, you think you take the collection of data within the past 6 weeks or whatever the intermeeting period is, and you make an assessment based on that totality. But when one data point appears, to have the ability to swing
Yeah.
their decision, it almost seems like data reactivity.
Yeah. It's
And so,
conflicting data.
yeah. And so
There's,
that leaves
yeah.
that makes it very hard to figure out what the next move is going to be. Another big item, of course, we get the SEP this meeting, and I think one of the things that they're likely to do if they pause is they're going to try to raise the median dot on their forecast for where the terminal rate is, to kind of show the market that you know that we've stopped, but we're not done yet. That would be the kind of messaging that I would expect.
What did they do? They just put white out on the other dots and then color in another one, Pedro?
and
How does that work?
just draw a rainbow around the top.
Pot
I
of gold at the end. Yeah.
exactly. Well, no, I think it works. They claim that it's all like individual policymakers not talking to each other and in a
Yeah.
vacuum, and then you just end up with a median. But it's kind of clear that the chair kind of he doesn't massage the dots himself, but I'm sure in his calls in his sort of pre-meeting calls with all the regional bank presidents and his fellow board governors, they kind of discuss where their dots are going to be, and there's some kind of pre-gaming as to where they expect the median to end up. And so,
Okay.
so they would do that by lifting the median from its current like 5.1 level to 5.4 or something a little bit higher, to reflect a little bit more hiking, at least another 25 basis points.
Do you have a dollar view or what you're looking for movements? I know we have the BOJ later in the week, but just a dollar. Um, I still feel that the market is still overly bearish a dollar. This rally wasn't embraced. Most even bulls said, it'd be a big deal for us to get back to 105. Euro has really had a hard time recovering off this initial decline from 110 and a half. Do you have any views
I,
on
I really
currency at all?
don't, to be honest. I really
All right.
don't.
I don't
I
blame
don't.
you.
I don't pay enough attention to the everyday
Okay.
movements to have a good opinion.
Okay. Because, the dollar is, kind of the fulcrum where everything revolves. Um, so just talking about the Fed and wrapping it, what do you expect from the presser afterwards? Do you think that Powell's going to be able to, satisfy people, or is it going to be, another cloudy message?
I think it's going to be cloudy. I think one of the issues with what we've seen in the last 6 months from his chairmanship is a lot of confusion as to what he's actually paying attention to. Seems like he brings up different things at different times and then they kind of fade away. At one point, JOLTS was the big thing to watch, right? But if you were going by that, then the recent rebound in JOLTS would be a case for continued hawkishness. Yeah. And he focused on ECI at one point, and wage growth is still fairly robust, but that kind of faded away. And then we changed to super core. So I think he's, and they've said there's not much movement in super core, which again would suggest that they should be hiking. One of the interesting things is one of the contradictions right now is that if you recall, right before the SVB debacle, Powell was actually hinting at a 50 basis point rate hike, and the market was pricing in a 6% terminal rate. Now, the question is, though, you and I may agree that these banking problems are not over, but the Fed seems to play them down and the market is playing them down as well. So the idea, my question is, if that credit tightening is not actually going to take place because of this regional bank turmoil, then shouldn't we reprice the terminal rate back to where it was before it? And so I think
that would be the surprise if he went ahead with at least 25 basis point hike. Would you think that would surprise the market?
That would be a huge surprise. I mean, I think even the market is so keen on having him pivot in some way and has been for so many months that any hint of hawkishness, I think, will be really negative for risk.
Okay.
And so, yeah, that's my general sense. But I think he's gonna walk a fine line, and he's not gonna say they're done, right? As some in the market would desire. And he's not even gonna say that like we're just gonna do one more and then we're done, because I think it's too open-ended and there's too much uncertainty around it.
Yes, great discussion once again, Pedro. Thank you so much for giving us some things to think about before we click our mouse over the next couple days. And best way for people to follow you, Pedro, Twitter and at MNI. Go ahead.
Absolutely. I'm on Twitter at PDacosta, PDACOSTA, and you can check out the website at marketnews.com. Check out the story that I have pinned to my Twitter account. It's gotten a lot of interest. We reported that the Fed is actually considering a shift away from the 2% target, potentially toward a target band, as some other countries have undertaken. The idea being that they're embarrassed that they were so such sticklers for like undershooting the inflation target by like 1/10 of a percentage point, and now they're trying to be more realistic. And I think a range might be a more realistic approach to inflation targeting. But it also leads to accusations that they're moving the goalposts and that they're raising their inflation target because they can't achieve it. So
they're not getting their credibility back. You know what's a great thing about a band, Pedro?
What's that?
They stretch.
Exactly.
A target is a target, but a band, lots of flexibility with stretching. Let's just say he now has a rubber band monetary policy.
That's a good, perfect analogy.
You can use it.
I will.
Thank you so much, buddy. Really.
Thank you so much. Thanks for having me, Dale.
Yeah, great catching up with you, Pedro.
You
Pedro
too.
DaCosta, everybody. Follow him at P DaCosta on Twitter and go to MNI and read their stuff, and it's going to edify you.
And check out my podcast. It's called Fed Speak, and it's available wherever you get your podcasts.
Yeah, is it what, Spotify and all those?
Spotify, Google, and Apple mostly. Yeah.
Okay, Pedro.
Thank you so much.
Great work, man. You're a watchman for us.
Thank you very much.
All right, Pedro. So that's a wrap, everyone. You could join the team in 20 minutes on the Morning Edge. Don't just count your pips, count your blessings. See everyone tomorrow. Adios. Thanks again, buddy.
Thank you. Take care.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.